As we mentioned in many episodes before, the risk of investing comes from lack of knowledge, and one of the most important things that an investor must be aware of is the company's financial statements. And the first thing in the financial statements is the income statement, which we will learn about today through the example of Apple Company, which we all know. Of course, the first thing we look at in the income statement is the company's revenue, in the case of Apple, which is the number of iPhones they sold multiplied by the price of each iPhone and other products, of course. However, phones are not manufactured for free, but there is a cost, and this is called the cost of revenue. I mean, for example, the price of mobile parts, workers' salaries, the factory's electricity bill, etc. When you subtract the revenue costs from the revenues, you get the gross profit. In the case of Apple, the gross profit in 2021 is 41%, looks pretty high, right? No, wrong, dear viewer, because the gross profit does not go directly to the company's treasury, but there are still other costs, and the first of them is the total operating expenses, which include general and administrative selling expenses, research and development costs, and general selling and administration expenses are what the company spends on advertising and the salaries of administrators and even CEOs of the company such as Tim Cook himself and so on. It certainly crosses your mind that you, as an investor, do not want to see these expenses increase in excess, but you want to see research and development on the rise. Because every company that ignores research and development fades and loses with time, such as Nokia and others that we can talk about if you want in upcoming episodes. In the case of Apple, we notice that its research and development expenses are on the rise, and this is a good sign. Thus, if you subtract research and development expenses and selling expenses from the gross profit that we mentioned, you will get operating income, which is a very important figure for investors because it is the income that the company obtains from its daily operations and it is a value that the company can control and improve year by year. Unfortunately, there are still other expenses, and the company controls them less, the first of which is the financing fees such as bank interest, and of course we do not forget the taxes, so we remove this cost from the revenues of the operations, we get the net income of the company and this figure is the real profit of the company. In Apple case, we know that the net income is 25%. In fact, it is an excellent percentage, and the judgment on this percentage varies from company to company, and from industry to industry, and so on. But what matters to you as an investor is if this rate is constant or improving year over year in large companies, while in small companies we check more the rate of the revenue growth. And certainly you found that the subject is easier than you imagined, but let me tell you that you must practice and practice until you understand the subject and then you can estimate whether the income statement of the company you want to invest in is good or not. And so, dear viewer, you became aware of the first part of the financial statements, and in upcoming episodes, we will talk about the rest of the financial statements so that you can invest knowingly and knowledgeably. I hope you benefited, and if you still have questions about the income statement, write them in the comments and I will try to answer them as soon as possible. If you liked the episode, do not forget to subscribe, like, and share it with your family and friends. Rashad, the presenter of your program Hit the Road to Fire, was with you. See you soon.